Welcome to the Deep Dive. We're here to take the sources you've shared and, well, turn all that complex info into knowledge that actually sticks.
And today we're getting into the mechanics of Canadian group benefits.
The coverage your employer sponsors. But here's the twist we're focusing on. We are not talking about your individual medical history.
And that right there is the core paradox of group A&S insurance. I mean, you look across Canada and almost 68% of workplaces offer some form of these non-wage benefits.
Things like life insurance, extended health, disability coverage.
Exactly. Millions of people are covered, and yet very few of them ever have to go through medical underwriting.
Right. Unlike individual insurance, where you might need a whole battery of tests, in a group plan, you're usually just in. You're automatically covered if you're actively at work. The insurer can't actually assess you.
Which forces a complete shift in how risk gets priced.
So I guess our mission today is to explore that shift.
For sure. If actuaries can't assess individuals, how do they set rates? How do they determine coverage?
Well, they have to focus on the composite identity of the group.
The composite identity.
Yeah, they look at the company's operations, its financial stability, the demographics of the group, all as if it were a single large insured person. This deep dive is all about that statistical risk management.
Okay, so let's unpack this composite identity. Let's start with, I guess, the biggest factor, just pure size.
It's everything.
So if there's no individual data, the insurer is basically forced to rely on general actuarial stats and, maybe more importantly, the group's own claims history.
Right, and the size of that company dictates the validity of that history. It all comes down to what we call the law of large numbers.
And when that law works, the insurer is confident.
Exactly, but when it fails, pricing gets expensive and very unpredictable.
So, okay, say I run a small marketing firm, maybe 20 employees. Is the law of large numbers failing me there?
It absolutely is. If you're a small group, let's say 25 lives or less, that law completely breaks down. Why?
Because if one employee has a single major costly claim, it wildly skews the data for that year. An insurer can't possibly rely on that 1 year to predict the future. The claims history has very little credibility.
Credibility. Meaning the sample size is just too small to be statistically reliable.
Precisely. So to solve that, small groups are often pooled together.
Pooled.
Think of it like buying in bulk. The insurer can't price 25 lives on their own, so they put them in a big statistical shopping cart with dozens of other small businesses.
So they gain enough collective mass to price them safely.
Right, but the trade-off is it usually means higher, less flexible premiums for everyone in that pool.
But what if you're on the other end of the spectrum? A company with thousands of members.
Then the exact opposite happens. The risk is spread incredibly wide. The group's past claims experience, especially for things like long-term disability, becomes highly credible.
So it's much more likely to match up with the established actuarial assumptions.
For sure. And that leads to more accurate rates and, much greater negotiating power for that employer.
Okay, let's get into the nitty-gritty here, because the sources talk about age and gender dynamics. They call it manual rating. Can you break that down for us?
Yeah, so manual rating just means the insurer isn't only relying on your group's claims history. They're also using these published, standardized risk tables.
And for group plans, age and gender are key inputs for those tables.
Huge inputs, especially when you're talking about disability and long-term care claims.
Give us an example of how that swings the price.
Okay, take gender. The actuarial tables show that a predominantly female group is, just statistically, likely to file more health and disability claims than a predominantly male group.
And I'm guessing age works the same way.
Absolutely. Older groups are vastly more prone to high-cost drug claims and long-term care claims than younger ones. So the insurer plugs your group's specific age and gender mix into those manual rating tables, and that directly influences the final premium.
All right, so then there's stability, or I guess lack of stability, the turnover rate. I was really surprised to see how much weight an insurer places on this.
It matters so much to an actuary.
Why, though? Why does it matter how often employees are leaving and being replaced?
Because stability equals predictability. It's that simple. If a group has low turnover, say 5 to 10% a year, it offers incredible consistency.
So the people filing claims today are probably the same people who will be there next year.
Right. And that consistency makes the group's claims history highly credible, very attractive to insurers. It leads to better pricing based on their own track record.
So on the flip side, if your company has a reputation for people moving on quickly, that high turnover actually makes its past claims data less valuable.
It completely diminishes the value. The risk pool is constantly being refreshed with unknown entities.
A moving target.
Exactly. High turnover almost immediately increases group premiums. The insurer might even impose longer waiting periods for those high-cost benefits like long-term disability, just to make sure the new people stick around long enough to stabilize the pool.
Okay, so let's shift gears a bit. Let's connect that idea of stability to the nature of the business itself. The type of work people are doing must have a profound influence on the risk profile.
Oh, it's fundamental. It's all about occupational classification. We tend to think of physical risk first.
Like a construction business.
Yeah.
More physical exposure, more accidents.
Of course, but now insurers are hyper-focused on what they call stress risk. Certain white-collar jobs, the ones that demand long hours or high-stakes performance, often lead to a greater number of work-related mental stress claims.
So for the insurer, the risk isn't just about, say, broken bones anymore. It's increasingly about burnout and mental health-related disability claims.
100%. The sources actually note that historically, occupations like architects are recorded as having very low disability claims rates.
I'm guessing that's because the physical risk is minimal and the environment is generally stable.
That's the thinking, yeah. That occupational profile tells the insurer exactly where to categorize and price the risk.
So what happens if my small business has zero claims data? The one we talked about earlier that got pooled. How does an insurer categorize my risk then?
They look to comparative businesses. If your group is small or brand new, the insurer will use industry-wide data from similar occupations, like, say, forestry workers, or a specific type of manufacturing job to estimate what your future claims might look like.
So it's like peer group pricing.
It is, until you accumulate enough of your own data to establish a track record, or get big enough to have that credibility we talked about.
And to get all this data, the demographics, the occupations, the insurer relies on the enrollment card and this thing called the employee census report. Let's do a little data deep dive here, because this isn't just paperwork, is it?
No, not at all. It's a strategic risk map for them.
Yeah.
They need those specific metrics to calculate the risk profile and also to determine the benefit levels.
Like date of birth, for example.
Right. Date of birth determines the age mix for the manual rating, but it's also crucial because eligibility for certain benefits, like long-term disability, often terminates at age 65.
And salary. That's obviously critical for any kind of income replacement benefit.
More than critical, it actually dictates the structure of the plan. Salary determines the benefit levels for disability, for sure. But in larger groups, salary or job title is often what determines the employee class.
Employee class.
Yeah, different classes, say executives versus factory floor workers, often qualify for entirely different benefit packages, different coverage limits.
So they're using that census data not just for pricing, but for organizing the whole plan into tiers.
Exactly. And of course, they need a list of dependents for family coverage, and the SAN is only collected for mandatory government reporting if the premiums or benefits happen to be taxable. It's a very specific operational data set.
Okay, let's move from physical and financial protection to mental and emotional stability. Let's talk about employee assistance plans, or EAPs.
Yes. This non-traditional benefit is now a massive factor in managing a group's overall risk.
EAPs are probably the most strategic part of a modern benefits package, wouldn't you say?
I would. They're a direct acknowledgement that personal, family, or work-related stress can significantly impact an employee's job efficiency.
And, crucially, it can lead to expensive disability claims down the road.
That's the bottom line. EAPs help attract and retain talent, sure, but fundamentally, they are a risk mitigation tool for the insurer and the employer.
So how is the plan structured to make sure employees actually feel safe enough to use it? I mean, confidentiality has to be key.
It is paramount. Almost all support is provided off-site and always through a third-party provider.
And that achieves two things.
Two things, yeah. It reduces the employer's direct cost, and it reinforces strict confidentiality. The employer rarely knows who is using the service, just the aggregate usage data.
And the services are consultation-based, over the phone or face-to-face?
Correct, and they usually have limits like deductibles, co-insurance, or a maximum number of hours per year.
We have a great example in the source material, a woman named Satya Ray. She works in a high-pressure medical supply company, dealing with stress-induced stomach issues, headaches.
And minor depression due to financial pressures. Her case is textbook EAP success. Her plan allows her up to 10 hours of counseling. The goal isn't just to make her feel better.
It's to develop coping strategies.
And most importantly, to prevent her condition from deteriorating into a formal, long-term, stress-related disability claim. which is, massively expensive for the insurer and disruptive for her employer.
EAPs catch problems early,
That's their entire purpose.
and the range of services is surprising. It's not just like work-life balance counseling.
No, it's incredibly comprehensive. It covers psychological counseling, 24-hour crisis management, addiction counseling through accredited centers, even marriage counseling,
And the sources also mention legal consultation.
which often surprises people. But yes, advice for divorce, wills, adoption, debt problems, even dealing with indictable offenses.
Now, this is important. We have to draw a clear line on that crucial Canadian tax detail. EAP benefits are not always non-taxable, are they?
That is the nuance everyone misses. EAP benefits are not a taxable benefit to the employee if the counseling is for physical or mental health, retirement, or general financial planning.
Loved.
But if the service is for specific legal or financial matters, like having a lawyer draft your will or getting specific advice on debt restructuring, that portion is generally treated as a taxable benefit.
So the reason why you access the counseling determines the tax status.
That's it. It's a fascinating distinction.
Finally, let's look under the hood at the operational machinery that holds all these plans together. The insurer provides the coverage, but they also provide all the specialized admin services.
Right. And these three operational services plan, member enrollment, premium billing, and claims adjudication are what turn a policy into a functioning workplace benefit.
Let's start with enrollment.
It starts with a qualification period, typically 3 months, which often lines up with an employee's probationary period.
And if the plan is non-contributory, meaning the employer pays for everything, enrollment is mandatory, right?
Correct. But most plans these days are contributory, where the employee pays a portion of the premium. And this is a crucial administrative point.
Because the insurer have to actively solicit participation.
They have to. They have to meet minimum participation thresholds. If HR can't sell the value of the plan and participation drops, the entire plan's stability and eligibility can be jeopardized.
So high employee participation isn't just good for morale, it's actually mandatory for the actuarial stability of the plan.
Precisely. And if an employee wants some kind of optional increased coverage, like, say, doubling their life insurance benefit, they might have to face individual medical underwriting, even though the base plan didn't require it.
Okay, then there's billing, which sounds simple, but I guess it's not.
For a non-contributory plan, it's easy. Insurer bills the employer. But for contributory plans, it's a two-step dance.
What's that look like?
The insurer bills the employer for their portion, and they tell the employer what the employee's contribution is. The employer then deducts the employee's share via payroll and sends the full amount to the insurer in one payment.
It requires some pretty tight coordination between payroll and the insurer.
It really does.
And finally, claims adjudication. This is the moment of truth.
Yes. It just means comparing the claim form against the contract terms. If a benefit is payable, they assess the amount. But for long-term claims, like disability, adjudication is an ongoing process.
You don't just approve it and walk away.
Not at all. The insurer is continuously responsible for monitoring that claimant to make sure they still meet the contract's strict definition of disabled.
So where does the group broker fit into all this? They seem to be the human element connecting the employer to this entire system.
The broker is the essential market expert and navigator. Their main role is to go out and solicit group quotes on behalf of the sponsor.
So they collect all that critical composite data we talked about?
Right, the group makeup, the claims experience, and they determine which benefits the client considers non-negotiable.
And their real value is knowing the marketplace, knowing which insurer is, I guess, hungry for which type of business at any given time.
Absolutely. They know which providers are actively seeking specific types of groups, maybe because that insurer wants to stabilize its own risk portfolio by pooling claims in a certain sector. The broker sifts through the quotes and selects the best one.
So after all this, what's the big takeaway for you?
Well, the core insight is just undeniable, isn't it? The success of these group insurance plans hinges entirely on managing collective statistical risk size, turnover, business type, rather than assessing individual health risk. That just changes the entire underwriting equation.
Yeah, and if we connect that to the bigger picture, that administrative backbone, from the data in the census report, the complex payroll deductions, right down to the confidential preventative EAPs, it shows these benefits are so much more than just financial payouts.
They're a really sophisticated data-driven system. It's designed to use aggregate statistics and administrative leverage to support workforce stability and health, all as a way of keeping that collective risk as low as possible.
Which brings us to our final thought for you to chew on. Since low group turnover and high employee participation are so valuable to insurers, leading to more credible claims histories and often lower premiums, what specific measurable impact does your company's benefits package have on its own employee retention rate? And is the financial savings gained from managing that stable risk pool being strategically passed back to the employees who created that stability in the first place? Think about how your workforce's decisions are literally determining the cost of your insurance.